All right, number 4. What's
Yes.
your ideal portfolio mix? I know you're not into Bitcoin because I saw you on a YouTube channel say you don't do Bitcoin, but what's your ideal portfolio mix?
I think this is going to be different to everyone depending on your risk tolerance and also your age as well.
Yeah.
So I'm in my late 40s now. So for me, I've still got a lot of time until retirement, and I just go for the growth side. So therefore, for me, it's 80% more towards 7 to 80% stocks, and then the other 20 to 30% on the property side. The reason why I like stocks more is because it's liquid, it's unleveraged, and in terms of what you're making. And then the other side, which I still like as well, the property is because of obviously the bank's giving you that leverage as well. And it is very much safer leverage compared to stocks. So having sort of both of them, but more towards which is where I'm strong at anyway, towards the stock side, having that grow without leverage, basically return on assets, return on equity is the same thing because of without the leverage side. But then the property side, you're getting that extra leverage side. So you're getting a higher return on the ROE, basically, return on equity.
But within your stock portfolio,
Yes.
for me, I have about 40% of my stock portfolio in banks because they never lose money. About 40% in mid caps, and I generally like ones that pay dividends. Some of the shareholder are buying and buybacks are on. So I kind of like those kind of stocks. I find them, and then I have about 20% in a mixture of REITs, real estate investment trusts, and about 5 between in that 20% about 10% REITs and 10 of play things, I call them, or the fund stocks, right? Low caps. What about you? In your portfolio of stocks, do you have a market weight of each?
So this will be a surprise to a lot of people. I don't, simply because I'm like the fund managers. I'm not. There's no, rule book that I need to follow. So for me, I just see what I do is I generally try to have 50% over time, growing a 50% long-term portfolio, and also a 50% shorter-term / income type portfolio. What that means is on the longer-term portfolio and both short-term portfolio, there's no percentage-wise where I say, I need to have this such and such in real estate investment trusts, such and such in banks, such and such in technology stocks. I don't have that. The reason being is that I allow the market to give me the opportunities. So when the market is on sale, I see what industry and what stocks are on the most sale. And if they're on the most sale, they are also the lowest risk. So we'll slowly add positions there. And it naturally just diversifies, but also naturally lets your portfolio, in terms of percentage-wise, diversify to whatever percentage it actually is based on what's on sale at that point in time. So if that makes sense.
Yeah. So you're, a bit more of an active trader. Are there any stocks that you've held for like 10 years or are they constantly rolling over?
Oh, yeah, for sure. So 50% of the portfolio is definitely more longer term. So they're not active traders. They're more where I'm going to be buying them and holding them for a long time. Because I always say that there are some stocks that should be held long term. And there are also stocks that should never be held long term. And the ones that are held long term, generally they've got a global presence. The likes of the Googles of the world, the Apples of the world, they've just got a global audience that they serve 8 billion people. Whereas even though I live in Australia, I generally more trade our Australian stocks. I love our banks, not because of the dividends. I love trading them twice a year. And I trade up the likes of Telstra. Don't like their financials because ultimately in these companies, their profitability is capped. Their so-called blue chip just means that they're big, but they don't necessarily mean that they're they are profitable, don't get me wrong, but ultimately their portfolio, their profit margins and profitability is always capped to that 26, 27 million people with migration coming through. So I'd like to trade them a couple of times a year because they just always, it's like a wave. They come down, undervalued, I buy them, overvalued, I sell them, undervalued, and then I just take that money and I'll go somewhere else. On the long-term side though, generally they're global companies. And I know that they've got this global audience. They fish, for example, like Apple, done with China. Now they're moving their factories and also their new clientele into India. So that's another 1.5 billion people to serve. So therefore, they're the longer term investments because I know over time their profitability will keep on going up and up and up.
Someone told me once, just buy 4 stocks, big, rather large stocks, and just trade them for the rest of your life.
Again, Tyro, that's why I generally go into the large cap because to trade them, way safer, but also much more liquid. So there's no need to go into the spec side, the mining stocks, stuff like that. For me, preservation of capital is number 1, and then making money is number 2.
Interesting. What about charting? How do you get charting involved or do it all involved that in your strategy?
I actually don't do charting at all. So all these trend lines, and I used to be a day trader using charts. So I learned all that. I spent probably at least $50,000 learning charting. But I did it for about a year. And then I realized that I made money, I lost money. At the end of sort of 18 months, I made no money. So through ego, I was a day trader. But in the end, did it make a difference in my life? No, it didn't. It got me excited and spent a lot of time staring at the screen. So what we do is, though, what they call technical analysis is actually quite simple. If you just boil it down to two things. Stocks are just like commodities and property, for that matter. They're determined by the prices, ultimately determined by supply and demand. And with stocks, very different. Unlike property, it's the demand and supply is actually ultimately in the end not you or I. We are very tiny players in the market. The ones who control the supply and demand are the institutions, the big fund managers, super funds, pension funds. So when these guys are buying, creates demand, pushes prices up. When they're selling, 50, 100 million at a time, they push prices down. And because we're value investors, we also invest very similar to them, finding the right stocks. And if we like the stock that they like, we wait till they buy and we buy with them. And if we are trading it and we see them start selling in a big scale, we sell with them because the price will also drop over time because these guys are selling hundreds of millions at a time as well. So if you boil it down, charting is just a couple of, I guess, volume type tools that just see the volume of these guys coming in, and they're not mums and dads volume, they're volume from the institutions. And that's it, literally.
The only thing I like about incorporating a little bit of charting into my trading is that charts don't lie, people do it.
Yeah, correct. Yeah, so there is that charting, but it's more on the indicator side. So we look at the stock charts, but we look at more on the indicator side of seeing fund managers come in and go out. And then that just gives you far more accuracy because, the thing, I don't know if you've drawn trend lines before, those for charting. When you're optimistic, sometimes both you and I can, we go through the same course and sometimes we're literally drawing even trend lines at the same different angles, for example, and we see different things. Yep. So it's very subjective. So I'd rather have something that's very black and white, nothing gray, where you go, should I, shouldn't I? It's either yes or no. So I prefer that. So what that means is that then you become an unemotional investor and trader in the long run. Yeah, and that's the thing that I think trips people up is that psychology bit that they don't have.
Excellent.